Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Union Pacific, which is one of the biggest companies in the industrial sector. Last, they generated a revenue of $21.8 billion and they have a market capitalization of $135 billion. Union Pacific is a railroad company that transports freight through the US. The revenue of Union Pacific can be divided into three segments, which are industrials, bulk, and premium. These segments can be divided even further. The revenue of industrials consists of 33% of metals and minerals, 29% industrial chemicals and plastics, 26% energy and specialized markets, and 12% forest products. The bulk segment consists of 31% coal and renewable, 40% grain and grain products, 10% fertilizer, and 9% food and refrigerated. The revenue of premium segments consists of 82% intermodal and 18% automotive. If you want to know more about the revenue, you can check out the annual report of Union Pacific, which I've linked down below. Enough about the introduction. Let's find out if Union Pacific is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Union Pacific is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. And the average of the last 5 years is 2.13%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve would give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Union Pacific is 7%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Union Pacific is 7%. This value is in the green section of a rating scale, and therefore I'll subtract 5% from the margin of safety. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, 37 cents were paid, and in 2022, $4.95 is expected. Union Pacific has paid and increased the dividend for 15 consecutive years, which makes them a dividend contender. In the last 5 years, the average dividend growth was 14.8%. A dividend growth of 14.8% is a phenomenal value and in the dark green section of a rating scale. Therefore, I subtract 10% from the margin of safety. By looking at the payout ratio, I'll find out if this high dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Union Pacific has increased from $5.2 billion in 2018 to $6.1 billion in 2021. The cash dividend were respectively $2.3 billion and $2.8 billion. The average payout ratio thereby becomes 46%. This value is in the yellow section of a rating scale, and therefore the margin of safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $28.7 billion and have $2.5 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $11.5 billion. This leads to a debt to equity ratio of 227%. The debt to equity ratio tells us that the company could pay off the whole debt in around 2 years if the whole EBITDA were used for debt settlement. This value is in the yellow section of a rating scale, which gives no further adjustment. For the business to be sustainable, growth is a very important factor. The revenue has increased from $21.2 billion in 2017 to $21.8 billion in 2021. This gives an average growth of 0.7%. In the same period of time, and the EBIT increased from $7.8 billion to $9.3 billion, which gives an average growth of 4.4%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 37%, and in 2021 increased to 42.8%. Since the EBIT increases at a higher rate than the revenue, it only makes sense that the profitability of the company increases. In this case, it increases with 3.8%. An EBIT growth of 4.4% is in the yellow section of a rating scale, which gives no further adjustment. For a margin growth of 3.8%, I'll subtract 5% from the margin of safety. The last thing I'm looking at is the potential yield on cost. This matrix tells how great a potential investment in Union Pacific would be and what annual income I could expect in a few years. Union Pacific has a dividend yield of 2.33% and a dividend growth rate of 14.8%. I assume that the dividend gets fully reinvested at the same conditions. But I'll subtract 15% from every dividend payment because there are 15% withholding taxes for stocks from the US. After 5 years, the yield on cost would be 5.5%. After 10 years, it would be 15%. And after 15 years, it would be 56%. I only calculate the potential yield on cost for the coming 15 years because of the natural uncertainty of this matrix. A yield on cost of 56% after 15 years is in the dark green section of a rating scale. Therefore, I'll subtract 10% from the margin of safety. Since every matrix for my analysis has now been collected, it is time to adjust the margin of safety. Minus 5% for the relative standard deviation, minus 10% for the dividend growth, minus 5% for the margin growth, and minus 10% for the potential yield on cost. I think that slide illustrates well how amazing the matrix for Union Pacific are, which can also be seen in the margin of safety, which decreases to minus 5%. This leads to a desired dividend yield of 2.02%. And by a current dividend of $4.95, I should therefore don't pay more than $245 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for Union Pacific is $232. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the margin of safety to the historical yield curve. This then gives a new curve which always lies 5% under the historical yield. As seen in the graph, the historical yield and the margin of safety are under the yield curve. Therefore, I consider the stock as undervalued. Finally, I consider the stock at its fair value when the price is $232. I would buy the stock at $245 and the stock price is currently at $212. If you did like the stock analysis, please consider to give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for more content.